Hi, everyone. Welcome, welcome. I'm so excited that you're able to join us today. We have Jerry and Tom, not to be confused with Tom and Jerry, another really awesome duo. But we will just wait a couple more minutes to have people filter in before we officially get started. While we wait, it's Jerry, Colin was telling me that in addition to your story, as far as you taking your daughter to ice skate yesterday for your time off, that you were a hockey player when
I
you were in
was. I
college,
played
right?
club hockey in college. I actually walked on, having never played really competitively before. I was planning to play lacrosse in college. Our season got canceled. I learned how to ice skate really good, and so my daughter gets to benefit me teaching her how to skate.
Oh, that's so great. One of my favorite movies is Cutting Edge. It's like
Oh yeah.
it's so good. But where are you located again?
Well, right now we're in Richmond, Virginia, but I used to live in Northern Virginia and went to college in Lynchburg.
Hmm,
Yeah,
nice.
not where
Tom,
you'd expect hockey to come from.
yeah, I know. I was gonna say I didn't think hockey was very prevalent over there. But what would I know? I don't follow that sport. Tom, do you ice skate or play hockey at all?
I have tried ice skating on 2 occasions, and my ankles will never be the same, so I don't ice skate. I'm a little big for that, but and Jerry's he's coordinated. I am not. I like watching hockey, but I can't imagine myself playing it.
Tom is one of our resident musicians and formerly a stand-up comedian.
And a chess grandmaster, as you'll see in a moment. So yeah, I've done some stand-up comedy,
Oh,
but I won't
that's
bring any of that to the table today. So
okay. Next time, next time. All right, folks. Well, let us get started. We are at 11:02 Mountain Time, so I'm going to kick this off. Welcome to today's Solution Spotlight. It is about the great debate, cash flow versus goal-based financial planning with Jerry Varela and Tom Vaea of Investment MoneyGuide. Here at XYPN, it's our mission to help advisors start, run, and grow the RIA of their dreams. And we offer all the solutions you need to run your business, and MoneyGuide is part of that solution set. So we are very grateful to have them here with us today and grateful to you for joining us. So before I turn it over to Jerry and Tom, I do want to review some housekeeping items. The first is that there is a chat in the tab, the Q&A tab at the very bottom of your screen. Please use the Q&A for any questions that come up. There will be time for some Q&A after this presentation, so that is the place to do so. And then also, because a lot of you are here to receive that CE credit, I just wanted to remind you that you will need to stay on for at least 50 minutes of the webinar to receive that CE credit. So just be sure to stay on for that amount of time and you'll be all set. All right, folks. Well, without further ado, I'm going to turn this over to Jerry and Tom.
thank you very much. Well, hello, folks. I'm Tom Vaya, chess grandmaster and financial planning guru, and I will be playing on behalf of goal-based planning, represented by the pieces in white. You might also notice my jacket. I have what you would call an intuitive strategy that I apply to the game.
Thanks, Tom. And my name's Jerry Varela, and I'll be representing cash flow. I'm also a chess grandmaster and financial planning guru. I take a more calculated approach to planning, and you could say the differences between Tom and I are night and day. Tom, why don't you go ahead and start us off by setting up the board?
Very funny, Jerry, very funny. So I will begin by setting the board here. So, much like the game of chess, strategy is the key to a winning financial plan. And like chess, there are various strategies one can apply to win this game. Now, today, we're going to pit the two most prominent strategies against one another, goal-based versus cash flow. These planning strategies are like two chess grandmasters, each secure in their tactics and their results, but is one better than the other? Let's find out which is the best financial planning gambit. So, I am going to start a little bit about the genesis of financial planning. In the beginning, accountants and bankers created cash flow, and they saw that it was good. It seemed a sound and reasonable way to predict a client's financial success. Look at precisely what the client is earning, what they're spending, create a budget, then set a course based on that budget and follow it. Now, this was the model that most financial advisors adhered to until the early 1990s. Then there was a new kid on the block, goal-based planning. And this means if planning didn't rely on the client creating a budget, instead it relied on the client providing financial goals at the outset, with the advisor building out a plan to accommodate those goals. Now, some advisors embraced this new planning models and others did not. Now, much like our politics of today, there are people on the right and people on the left, and I think they often want the same outcome: a stronger economy, better schools, maybe a more just society. But it's how we get there where we diverge. So I think the same can be said with financial planning. Advisors want to act in the best interest of their clients and provide them with the best financial plan to help them accomplish their financial goals. But how is the client best served? By a goal-based plan or one that relies on cash flow? They are different, and there are those who will tell you one is better than the other. So we're going to be actually looking at each. Now, my first move is going to be to go ahead and take a look at our agenda here today. So first, a basic introduction into how each method works. Jerry's counter move is he's going to go ahead and explain to you how cash flow operates. Then he's going to come back to me for my move, and I'm going to explain how goal-based planning operates. Then I'll jump directly into basically the benefits and considerations of goal-based planning, and I'll even take an opportunity to jump into a software platform that uses that methodology in creating a plan. Then Jerry's going to have his counter move, come back, talk about the benefits and considerations of cash flow planning. And again, he'll be demonstrating that in a platform to give you a better understanding of it. Finally, we will be asking you who you think won this debate, and we will have some final thoughts.
All right. Well, with that, I'll go ahead and take over. Tom, I know you were really quick to make that first move, but let's set the ground with cash flow planning. So cash flow planning is really the original planning philosophy. And just to make sure we're all on the same page, everyone, let's go ahead and break cash flow down with an analogy. So recently I needed to build a shed for my wife and I's motorcycles. And when we were thinking about building the shed, we started at the big box stores looking at the ones you just essentially assemble at home. But we ran into a challenge with those ones that had all the engineering. They were built for unique purposes by their designers, but it didn't fit our needs. Now, with me being a draftsman and my wife being great with woodworking, we were able to design our own shed using the sources of materials that we wanted with our own design and get exactly what we wanted. Wasn't necessarily the quickest approach, but due to the level of detail that we had control over, we were able to create exactly what we need. So with cash flow, it's really all about getting into those details. And I'll break down the essence of the philosophy for cash flow with an acronym, SIGHT. So what the system will attempt to do, or what the philosophy attempts to do, is calculate how much you're able to save pre-retirement, or to some degree, in some cases, spend from your portfolio based on taking all of your income, which is very easy to identify. From there, subtract out taxes. And this is where leveraging technology can help. Not all of us are enrolled agents or CPAs or just expert in taxes on general, but it's an important piece of your client's cash flow. And then reducing that income by expenses, your client's budget. And if we're able to be accurate there, we can precisely tell the client how much they are able to save or what they might want to spend. So now let's take a second to think about that philosophy in essence of the 7-step CFP planning process. So in the 7-step CFP planning process, I really want to hone in on those first 3 items because that's where you're going to see a differentiation in these two philosophies. So if I start by thinking about understanding a client's personal and financial circumstances first, I'm going to be looking at things like debt and assets, the balance sheet, their budget, what does their cash flow look like, where can I identify potential options, and where's my client's essentially place where they are right now. And that is a great lead in to identifying and selecting goals, that second step. Think about it this way. If we understand our client's budget, When they say one of their goals is to purchase a new car, based on that budget, we can understand if they can afford the $100,000 sports car they want, or are they going to be maybe looking at something used where maybe that would better fit into their cash flow. Because it's one thing to want all of these great things, especially material things in life, but that doesn't mean we can always afford it. And cash flow will help bring that to light. And then we can analyze the client's current course of action. So if we project out your cash flow over your life, what opportunities exist? Are you going to run out of money? Or can we encourage you that you can actually expand your spending because you have the affordability there to put your kids through private school, maybe purchase your dream home? Do you need to decide between cash purchases or financing those purchases? And then we can make decisions or alternate courses of action based on what that cash flow projects out to. And so that's really where cash flow really helps in that first 3 of the 7 steps of the CFP's planning process. So now with this, I'll turn it over to you, Tom.
All right, Jerry. Not exactly the move I would have made. Let me see if I can go ahead and get myself on screen here. There we go. Again, not sure that would be my choice, but let's get on to goal-based planning. So goal-based planning, let's talk a little bit about the concept. And I'm going to start with an analogy. And I want to make it clear that this is not entirely original. I did hear it somewhere else. But I think it hits home when understanding goal-based planning. If I am about to go mountain climbing, what is the most important thing I'll need to prepare? Is it going to be climbing gear? Is it going to be food? Maybe it's going to be transportation. Well, it's really none of those because none of it really matters without knowing the most important piece of information. What mountain am I climbing? So, am I about to climb Sharp Top Mountain here in Virginia? And yes, this is a real place. It's a nice relaxing hike, about 1,300 foot for the ascent. Or am I looking to climb K2 in the Himalayan range, over 28,000 feet, and perhaps the most challenging ascent in the world? So the mountain is the goal, and everything in a well-developed plan or financial plan revolves around the goal or goals, the mountain or mountains I want to summit. And goal-based planning knows this and begins by asking the clients what financial mountains do they want to climb? Retirement, paying for a child's education, travel, maybe it's all of those. And what mountains are most important to summit? Which are steeper? Which are less treacherous? So let's leave the geography analogy behind for now and simply refer to these mountains as goals. Also want to mention that goal-based planning emphasizes strategic financial planning. We ask the clients up front to tell us their long-term financial goals and tell us what they've done thus far to meet those goals. Then we can see if they're on track, or do we need to make some modifications? Will they need to adjust their current financial tactics regarding saving, spending, or investments? Goal-based planning doesn't get hung up in the client's day-to-day spending, but focuses instead on the client's reliable financial habits, aspirations, and risk tolerance to meet their financial goals. All right, so let's go ahead and jump into some of the benefits of goal-based planning. And the first one, kind of in relation to what I was just talking about, is let the client dream start with the end in mind. So the client's goals are their end game. As the name implies, goal-based planning. And this is where we start. We don't begin with a budget, but with a focus more to the future. And I would say this, let's face it, what is a more engaging way to begin a financial plan? Saying to their client, tell me your hopes and dreams, or let's sit down and get to work on a budget. I know which one I would find more engaging. And kind of in keeping with Jerry's mentioning, that here we have that 7-step for the CFP board. The second step in the CFP board's 7-step process is identify and selecting goals. Goal-based planning, in effect, applies this step early in the planning process. So we begin the process by engaging the client with what matters most to them. What do they want to accomplish in life and in retirement? Second item, no need for an extensive budget. SIGHT. So Jerry did a great job of showing us SIGHT, basically the acronym saving equals income minus taxes minus expenses. So this tells the client what they could save, or more realistically, what they think they could save. And quite frankly, if I'm creating a budget and maybe I'm sitting down with the client, getting their income is pretty simple. What are you earning? I can get their W-2s, their 1099s, their K-1s, whatever the case may be. Minus taxes. I can pretty much calculate that too with a progressive tax rate or maybe applying the marginal tax rate to things like capital gains. E is going to be the harder part, though, getting their expenses. I know if I sit down and you gave me a full hour to do a budget, that if I put it together, there would be expenses I was forgetting. I might forget that again, yes, I basically have a bundle on my cable for Apple and for ESPN. Oh, that's right, I get a latte every day. So again, Site does a great job of telling the client what they think they can save, but often it's not what they can save. It's what they'd like to be able to save. So goal-based planning does something different. It's a little more simple. As you can see, the equation is far easier to understand. Savings equals savings. And what we mean by that is we simply ask the client up front, okay, what are you putting into your 401k, your 403b, or your sweep account? Because right now we can rely on that. We know as a fact that, hey, if your 401k, you're going to continue to contribute that. With that site under cash flow, let's imagine the client's car breaks down. That budget can get scrapped. But quite frankly, if the car breaks down, they're going to continue putting their money into their 401k, the 403b. That is probably not going to change. So again, what we take into account is we want to look at the savings we can rely upon, not what the client just simply thinks they would be able to save. And again, I think it's more reliable information. All right. So let's look at the other items here. Quickly establish if your clients are on track. So very often the client's going to ask, am I on track during the creation or later on when we've created the plan, they want to see where they're at. Cash flow can tell you this, but it'll likely require much more maintenance and upkeep than a goal-based plan to reliably answer that question. And that's because cash flow is more reliant on that up-to-date data to remain accurate. As a result, this could require you to charge the client more to maintain that plan. And it's important to remember that more detail may not mean greater accuracy. So the real question is it worth your time as an advisor and the additional cost to the client? Easier to understand. So for clients, data provided from a cash flow planning context can be a bit overwhelming and difficult to understand. Now, goal-based planning, as well as we'll see in a moment, can provide the client with a great deal of data if needed, or detail if needed, but it won't require as much detailed information from the client to build the plan or to understand the results of their financial plan. Appropriate for long-range planning. As I mentioned earlier, goal-based planning has a greater strategic focus, basically long range. It's built to have the client concentrate more towards the end game, achieving those financial goals, climbing those mountains, rather than focus on the ups and downs of their day-to-day spending. Now, while cash flow is a greater focus on that day-to-day spending, goal-based planning looks at spending as it pertains to savings, the savings that will be applied to the client's goals or to pay for those goals. And it's by its very nature best for long-range planning. Allows for greater collaboration with the client. Because goal-based planning requires less data upfront than cash flow plans, most clients are going to feel at ease in co-creating the goal-based plan. As we'll see in a moment, a goal-based plan starts by asking the clients the fun stuff, and sometimes even the worrying stuff up front. It doesn't begin with budget and bank statements. It begins with the client's hopes, dreams, and sometimes even their insecurities, as we'll see. So those are going to be the things that are going to be top of mind for a client when they come in to make that plan, or even update the plan. That will be the things that are top of mind, and that should make collaboration with the advisor easier, as you'll find. And then finally, doesn't promise success. So no one can or should promise success of the plan. Goal-based planning takes the most relevant components and focuses on those alone: goals, reliable savings, investment, and risk score. Now, when focusing on long term, the level of detail provided by cash flow can be a bit misleading. For example, a cash flow plan may provide you with a down to the dollar detailed amount for tax expenses in year 1 and year 30. And there's really no way to know this information given all the variables that could change in that period. That said, the client may make critical decisions based on that information, assuming the detail is backed up, basically is valid. The detail is valid that they're seeing looking so far into the future. And I think when it comes in regards to financial heuristics, basically heuristics is going to be a case where the clients have to make very important decisions based on limited information and they have to do it rapidly. A detailed cash flow assessment may induce what I consider paralysis by analysis. Too much information can impede those mental shortcuts the client needs to make when it comes to making a quick and adequate judgment. So with that, again, some of the benefits of the goal-based plan, what I'd like to do is go ahead and take a look at an example of a goal-based plan and kind of give you a run through of some of the things that we might see in that. There we go. Let me go full screen here. So here we are in a platform that uses goal-based planning as basically this is the methodology it's going to apply. And what we're looking at here is actually one of the first pages that we're going to find in the plan. And one of the things we're going to start with is asking the client right up front, tell us your expectations and your concerns. So in this plan, we've just gotten a little bit of personal information. We haven't started talking to them about their investments, their assets, insurance, or anything of that nature. We're saying, tell us what you would like your retirement to look like, or basically your expectations of the plan, and tell us what's keeping you up at night. And in this case, the clients have told us active lifestyle, time to travel, time with family and friends, less stress, peace of mind. And I can use this information right up front to start creating goals for the client. As we'll see, goals will be imperative to the plan, basically expenses that they'll have to pay for with their portfolio. And this can give me some guidance for that. Just as important, if I look over to the right-hand side, I'm going to see concerns. What's keeping you up at night? And again, it could be running out of money, someone dying early, suffering investment losses. And you'll even notice that we prioritize these goals. Tell us which ones are the higher and the lower ones in the plan. And why I think this can be very important is very often when people want to start a financial goal plan, what's going to basically motivate them is maybe they've seen a friend or family member who's gone through a crisis. Maybe someone has passed away and their estate was not in order, or maybe someone lost a job and they weren't prepared for it. And that will often be the motivator to come in and start talking about the creation of a plan. So we want to know that here from the client. We want to say what is concerning you. Something you'll also find with the goal-based plan is we'll get this information and right away, we'll basically not do anything with it initially. What we're going to do is build out a plan, and then we can later test how these events would impact the plan. Just letting the client know, great, tell us about this, and we'll go ahead, stick with us. We'll test this out in the plan and see if these are valid concerns, and then talk about ways of addressing it. So as you can see here, we're starting right out of the gate, letting the client know that we're going to personalize the plan for them. And I will tell you, some advisors will see this initially and think, well, that's too touchy-feely for me. But what they tend to find is when they use it, the clients are surprised, but pleasantly surprised. No one's really asked them these questions before when creating a financial plan. All right, so we're going to go to the next page here of this plan. Again, we just had the client's personal information. We are going to ask them about when they're going to retire. Again, we have sliders here, kind of the co-creative nature of the goal-based plan. Tell us when you're looking to retire. The client can move it if they want to, but they're telling us they're looking to retire at 63 and 62 respectively. And we also look for an appropriate planning age. So again, something that we can put into place. This can be changed. And we also have what we call willingness indicators, asking the client, are you willing to change retirement if that's something we need to recommend? If they say no, not at all, we could again look to their spending or their savings. Otherwise, if they say they're very willing in this case, we could make a change in regards to that. So these clients are looking to retire at 63 and 62 respectively. Our next page is probably going to be one of the most important pages, as you might imagine with goal-based planning. This is going to be the creation of the client's goals. So what are the goals? The goals are going to be the expenses the clients have to pay for out of their portfolio. We don't want to add anything here the client is paying for with their employment income because we don't need to track that. What we really want to know is, okay, what things are we going to need to take care of out of your portfolio or your savings? And we'll see these various icons at the top where the clients can choose different items. They can choose one and then bring it down to this corral and they can prioritize it. How important is it? So I've already built out some goals here for this client and I have prioritized them. You'll notice here at the very top, we have our basic living expenses. So with all these goals, we do create a quantity for them. We quantify them. We say, how much are these going to be in current today dollars? And we do imply an inflation rate to them. So under the client's needs, for example, I can see their basic living expense, their non-discretionary costs, their healthcare, and their SUV. And again, this makes sense. We would put these as needs. These are the things I need to retire with dignity. Wants. They're important, but they're not essential to keep a roof over my head. The clients are looking to pay for their child's college. They have a child named Abigail. She's under 18. They're going to pay for college, and they'd like to travel in retirement. And then finally, we have our wishes, kind of our blue sky items, fun money, home improvements. And what we've done here is we've gotten these goals in place, we've put them in order, and we've also prioritized them, and that can be very important. Some advisors may be very tempted just to try to throw everything into one goal and just say that's the amount they'll need in retirement. But by doing it this way, if later I have to make recommendations to the client, maybe reduce their spending, if I put it into one goal, they would say, in what? By doing it this way, I might say, you know what, we need to reduce your fund money, but the good news is your needs and your wants are going to be okay. So again, by prioritizing it and quantifying it, we're really doing the client a service later on if we have to start making recommendations. And again, engaging the client can choose these various items. You could give them the mouse, they can start bringing that in, and you can have that in-depth conversation about the costs. Maybe we want to prioritize it and such. Now, do want to mention here that we see these goals. You may say, well, Tom, okay, we haven't even talked about the client's assets yet. And you're right. If I go to the top of the page, I can actually kind of see where we've been. We were in the personal section. We've gotten to goals. Right after that, we're going to be in a section called money, where I can start talking to the clients about their Social Security, their retirement, their investment assets, their other assets, insurance. And what I want to kind of stress to you here is sort of the philosophy again that we find within goal-based planning. It is life before money. We want to know what you'd like to accomplish. We want to put this into place. And then later, we can start making recommendations on how to match that. So again, it's not that we ignore the client's investment assets or the other assets or insurance that they bring to the plan. It's just we enter those in after we've gotten those expectations and concerns, and we've put the goals into place. All right. So with that, I'm not going to go through every section here. We've gone ahead. We'll ask the client about their investment assets, their retirement income, their Social Security. Finally, do want to note that we always ask for the clients for a household risk score before we start making any recommendations to them. We give them a risk continuum to say, okay, where would you fall on this as a couple, going from 1 to 100? 1 being the person who is most risk averse, 100 being the person who is most comfortable with risk. And there's a little bit more to this than I'm going into, but just wanted to mention these clients have mentioned that this is their risk score. So now I have their goals, I have their expectations, I have their investment assets, I have all the assets they have to apply to this plan. So my next stop, I'm going to go to the top here, is current scenario. So quite frankly, now that I have everything from the clients, you'd say, okay, well, how does this plan operate? How does it look? Well, it's a simple question, but it's not going to be a simple answer. So we say to the client, you can actually see the way this software is built out. We're asking it directly to the client. It's really not a question for the advisor. Can I fund all of my goals without running out of money? Again, there's no way for us to know that because we're looking into the future and their investment assets can go up and down over time. What we do instead is we run 1,000 Monte Carlo simulations, basically generating random returns every year based upon their current investment assets, and then seeing how many of these are going to satisfy the goals they have and still leave money remaining in the plan, and how many are going to run out of money. And in this case, these green are indicating the client's trials, or we call plans, where they still have money left in it. In red are the ones where they're running out of money. We take the total number of trials and give you a probability of success. So again, what we're seeing here is just saying, okay, given what you currently have, how can we use that to show your probability of success? Now, this is showing what the clients are currently at with their investment assets. Is 45% great? It is not. But this, again, is where goal-based planning can come into account, and we can start looking at changes we can make to get them into what we call this confidence zone, or 70 to 90%. I'm going to click Next, and that's going to take us to the plan or the page where the magic kind of happens. We have tools to get the clients into the confidence zone. So what I'm going to see, they're at 80% because I've already gone in here and made some changes. But looking over the left-hand side, we'll have various strategies and options we can use to get the clients into the confidence zone. Strategies are ones we can use just to change aspects of their plan, but doesn't affect their lifestyle. We aren't going to ask them to retire earlier, save more, or spend less, but we might change their Social Security. We might look into an annuity asset here with a secure income, and tax planning, maybe a Roth conversion. Now, many of these strategies aren't going to move the needle a great deal. So we have these tools called options. And one of the tools we hit on here is called SuperSolve. Now, I'm not going to go into SuperSolve, but I'll tell you what it does. It's going to look at that plan where they're at 45%. It's going to take a hammer to it and say, what changes in lifestyle, retirement, saving, and spending would we need to make to get you into the center of the confidence zone? And we use that SuperSolve tool to get them to 80%. Now, that's just changes that the system is recommending. It's not the client who's making those decisions. So once we use the SuperSolve tool, we would always take the clients to this tool called PlayZone. And once again, this is an engaging place. The clients can help co-create the plan. We can say, okay, we got you to 80%. We'll show you the changes the system said you needed to make. What do you want to do? So right now I can see they're at 80%. I can see the retirement age. I can see the goal spending that they had and any savings. And they might even notice that, you know what, the system said we had to get rid of the home improvement and the fund money because it said those were your least important goals. Well, the client could come back and say, you know what, I really want to do the home improvement. They could type that in, 50,000, and I really want the fund money of $5,000. And when doing that, we'll go ahead and recalculate their probability of success and see the impact. So we're at 52, not great, but here's where the client can make a trade-off. Remember they mentioned retirement, 63 and 62, but they said they were open to changing it. So what if they go back and change it to 64 and 63? We can take that into account and see the impact it would have. Now they're at 64%. They might even come back and say, you know what, that basic living expense was a little on the high side. We had it at 89. What if we take that to $80,000? After kind of thinking about it, we think that basic living expense was a bit on the high side. Now we're at 77%. So we're getting there. If they wanted to increase savings, for example, maybe they have a matching 401k, they didn't go to the total amount. Let's do 8% here. Again, we can see any changes that will occur here at the top. Now we're back to 80%, but now the client's been able to put their stamp on the plan. And if we want to, we can save it now as their recommended plan. And now that 80% is the same as we saw it, but now the changes were made by the client themselves. They had a say in it, and now they're probably more likely to carry out the plan that they got involved in the creation of it. So I'm going to exit that page. And one of the last places I want to go to here is just to point out that when we're talking about goal-based, very often the complaint is there's not enough detail here. Well, we have plenty of detail when it comes to goal-based planning. As a matter of fact, we see this Monte Carlo meter here, that 80%. If you want to, you're going to see an explore menu underneath. This is basically, if I want to, I can open the hood and see details regarding this plan. Now, there's far too many links here for me to touch on, but the one I do want to show you, if I go down here, it's the 6th item. It says combined details. So I'm going to go ahead and open that up. So if you want to see details regarding a plan, this is where we can see it in goal-based. So very here at the top, I'm going to see a portfolio value graph. This is going to show me the clients, the assets within their plan starting today, going to the end of the plan, assuming an average rate of return. And these are their qualified assets, and these are their taxable. Now, perhaps even more important is this portfolio value chart underneath. This is a way to see the plan from a 30,000-foot view. So if you ever want to see what's happening within the plan, I can do it here. And as I mentioned before, we're starting in year 2024, this year, and taking it from womb to tomb, to the end of the plan here. When Amy passes away, she is the second to die here. And what you'll notice, we start with the assets they currently have, their earnings, the portfolio value. I can see when the goals are coming into play. And if I want to, I can even jump into a specific year, see the value by tax category, post-retirement income, investment earning, taxes, and even how the funds are used.
Yes, Tom, that's a lot of detail, but I think I have you in check.
All right, Jerry, let's see what you got.
Let's see how cash flow approaches this now. So I'll start off with the benefits of cash flow software, really starting with the details matter. They're going to be clients like your ultra high net worth clients, your business owners, your CPAs that are going to need that extra level of detail. Also, when you think about the financial plan, it's not always about how you manage their money. It's really for the client, what they're able to keep, not just what they make. And being able to identify where those opportunities live require us to look at that pre-retirement cash flow. For your business owners, it may not come down to, do I want to sell my business and how much am I going to receive? But the loss of that business income, what does that mean for my net cash flow? How is that money going to be invested? And can I replace that with maybe allocations that provide income? Speaking of income, with cash flow, we can get more into the categorization of that income, helping to differentiate specifically between things like Social Security and the income that's being distributed from your portfolio, helping clients maybe realize that reallocating to a more conservative portfolio may lead to lower returns. However, they might receive more investment income, which might be something that they appreciate. For your clients that have difficulty quantifying the goals, this can help them identify what they could potentially afford. How much more could you afford to spend? You have a greater ability for tax and estate planning within a cash flow software. We're going to be able to see how your clients could evaluate charitable gifts versus a charitable remainder trust, and being able to go into the details of showing them income tax savings as well as the impact to their estate plan. For your clients with extensive debt, we can better track where they're able to save more as debt's paid off, or if they were to sell their primary residence and downsize into a more affordable home once they retire, and what that might do for their cash flow. So we'll go ahead and look at an example of a cash flow system now at this point. And I'm dealing with some younger clients, as you can see here, Kyle and Samantha, 46 and 44 respectively. They are still working. We could see their information summarized off to the right. And I will say Tom did a great job of showing some engaging features, but I'd also point out that when we're in that first step of analyzing our client's personal and financial circumstances, knowing your client's family dynamics is extremely important. You can see these clients have 2 kids. Looking at the age of one of those kids, James, is that child already in college? Are clients trying to figure out if they can afford to put some of their income towards James's college? Also, with expenses, instead of goals, we'll be looking at expenses here, and we can get as granular as we'd like and list out each expense as a budgetary item, or you could take a quicker approach and roll a lot of those expenses that are going to happen throughout a client's life all into one expense. But it is important to know that we have the ability to manipulate these at an expense level. And if the income exceeds our expenses, then the program has the opportunity to actually save that income. So we can see what those savings opportunities are. Continuing on with understanding our clients' personal and financial circumstances is taking a look at their balance sheet, which not only includes the assets that our clients own, but often in a cash flow system, you can show assets that are inside of an irrevocable trust or those assets inside of their donor advised fund, really helping us to truly understand a more complex financial picture. Then as it relates to analyzing our client's current course of action, we can look at the next 12 months of their cash flow, which is represented in this case, looking starting here in February, ending in January, and the dotted line is those average monthly expenses. From there, we can educate the client on their income as it relates to those expenses. We're doing this graphically, but it's important to know that you also have the ability to switch your view and be able to look at this in a more itemized fashion to see those expenses. From here, the client's question is, all right, at the end of the next 12 months, can I save more? Or am I actually going to be reliant on my portfolio, which is a great precursor into a long-term cash flow plan? So when I levelize, I can find out, do I have a surplus or deficit at the end of the year? And this could take your conversation into different ways. The deficit may not be bad, but it does mean that our clients might start accumulating debt. It also means they may need to be going to their portfolio, their checking account. So they might want to spend less. And you may want to model, well, if you spend less, what does that look like? Do you have a surplus or deficit? And if you have a surplus, we could then talk to the client about saving that surplus. So depending on the client, they may have a surplus, they may have a deficit. For a retired client, pages like this can be a great opportunity for them to just understand when they're not working anymore, how their investment portfolio, RMDs, business income, and so forth help support their cash flow at a granular 12-month outlook. From there, the conversation will move to a more long-term analysis. And at this point, for many clients, they'll be able to see if leading up until retirement, are they building wealth or maybe not? In which case, if they're not building wealth, we may want to encourage them to spend less. Now, this view right here is focused on the value of my client's portfolio over time, providing us with a nice visual that the plan is ultimately running out of money. However, we can also see a Monte Carlo result here and what the end of plan net worth is. So sometimes portfolio assets can go to zero. That doesn't mean our clients are dying with nothing. They could still have property and other assets supporting their lifestyle. Now, if I go back and take a deeper look into their table view, this tells that story of that first 12 months, but again, over a long-term plan. At this point, I can note any net cash flow that my clients might have. So we can see these clients do, unfortunately, have some negative cash flow, which means leading up to retirement, which is at 63 and 62 respectively, really means that we should probably go ahead and build out some strategies to tell the client to spend less. So building that strategy in, we can work with our clients to decide how much they can reduce their lifestyle by to help support lower net cash flow. And then we can see how that impacts them from a nice visual perspective of their portfolio. Questions may also arise. What if I were to reallocate some or more of my accounts? You'll often want to be prescriptive here. Some advisors will take a client's qualified money and make it more conservative, so that way the ordinary income tax isn't really coming into play as much. And they'll take their more aggressive accounts and invest the taxable accounts more aggressively. really having that control is going to be really important, and the timing of when somebody reallocates. So it may be appropriate to reallocate them right now, but we may also want to consider a strategy where they reallocate again down the road, creating essentially a glide path of getting more conservative as we get older. Other considerations your clients might have is when diving into the details and looking at their outflows, liabilities could play a major part of their cash flow. And oftentimes when your clients have young kids living at home, they need that much larger home. However, as we start to look closer into when the clients retire, does it make sense to stay in that same home? Or does it make sense to maybe cash out, buy something a little bit more affordable? Now, while speculating what interest rates are going to do over the next several years is definitely going to be something that's a little aggressive, but what we can see is if our clients kind of keep all things being equal, but essentially do buy a smaller property, and even if they finance it, we could pay off their primary residence and then have a lower liability payment in retirement. And we can evaluate the difference between doing a 30-year mortgage versus a 15-year mortgage and using different alternate strategies. Another thing that may come up when you're looking at this detail is when your clients do decide to move, they may be currently in a state that has high state income tax, such as Virginia, and maybe they want to move to Florida. And then after that move, they can benefit from not having that state income tax anymore. Again, visualizing that in the details. There's several ways to look at details. Oftentimes looking at the entire cash flow over the life of the client can be a bit for a client to take in. So focusing on 5 years might be more relevant. In fact, often if we just look at the first 5 years after somebody retires, we might find unique opportunities where maybe things like taxes are substantially lower, and then they jump up as your clients have to withdraw from qualified accounts or get into RMD phase, really helping us open the concept of things like Roth conversions or spending qualified money first. Now, these clients, as you can see, were working towards retirement. We did have to make some suggestions, but what about your higher net worth clients? Well, with a higher net worth client, such as the one we're looking at here, their focus might be more on the comprehensive nature of their assets. For example, when we look at their entire net worth, is a substantial part of that a business, which might lead us into some estate planning considerations, business continuity considerations. So with cash flow, taking a deeper look at a client's estate really starts with understanding complex family dynamics. What charities are important to you? What trusts have you set up? What are your family situations looking like? Oftentimes, we're dealing with blended families where, in my case, these two kids, James and Beth, are Sue's kids, but they're not the biological children of Bill, her husband. What if he decides to disinherit those kids? Well, at first death, most folks' estate planning is a basic I love you will, which means when the first person dies, in my case, Sue, everything goes to the husband, Bill. However, the challenge might arise when we get to a second death, where in this case, Bill may decide to disinherit the kids, and the only money the kids are going to actually receive is ones where they're named as a specific beneficiary. So we could see those kids are missing out on quite a substantial amount of funds. Now, not only do we have an issue here where the kids maybe aren't going to get their inheritance, but we also may identify, based on the projected value of assets, do your clients face a federal or state estate tax issue? So this is where we may want to identify if your clients do face that federal or state estate tax issue, which right now we all know the exemption amount is $13,610,000 per person. And with portability, clients get to double that. However, with that being said, that law is set to sunset in 2026, reverting the exemption amounts closer to $7 million. So that's one consideration for clients that maybe aren't facing a federal estate tax today. But another thing is, even if that law does not sunset, when we factor in the growth of those assets, we might see where clients face that estate tax. So if we summarize and really look at evaluating various different types of trusts, you can work closely with a trust attorney to figure out what trusts are going to make the most sense for your clients. A very common trust is an AB trust. So that might be presented by an attorney to your clients. And that would help in the case where we need to specifically name James and Beth as remainder beneficiaries so that the surviving spouse doesn't disinherit those kids. However, with an AB trust, because it's testamentary in its nature, it doesn't always alleviate federal estate tax. So in this case, our clients are only saving about $1.5 billion in their estate expenses, which is where an alternate might be presented to your clients. Instead of the AB trust, let's take advantage of the exemption today before the law changes. So set up an irrevocable trust like a spousal lifetime access trust. That will once again protect the inheritance of my heirs while also making sure that we do a good job of reducing any federal or state estate taxes. Then it comes back to, okay, this all looks great on paper, but Jerry, that's an irrevocable gift. What are my clients going to do? Are they going to run out of money now that we've made this irrevocable gift? Well, using the estate plan in conjunction with your cash flow plan will help you to understand that, yes, you might see a reduction in their assets, but leveraging this portfolio graph as well as the Monte Carlo result, we can still see if our clients have gifted themselves into poverty. In addition to this, when we're looking at the estate plan, we may want to look at that survivor's income after we've enabled various different trusts. So being able to just quickly tune in and see, all right, with that survivor, do they have enough income? Is their net worth going to be where they feel comfortable? Because we definitely don't want some animosity between this client and their spouse over these irrevocable gifts. In addition, when it comes to heirs receiving money, does it make sense for them to receive that money in equal portions? Well, estate fairness is often preferred to estate equalization. What I mean by estate equalization is we give everything 50-50. However, oftentimes, especially with your higher net worth clients that have multiple children at home, they often will provide more financial support. They might have paid for weddings, helped one of their kids purchase their first car, where the other child, for whatever reason, didn't get to receive those benefits. The program and the tool will often display to you, have you given an equal share to each of your heirs? And if not, what would you need to equalize their gifts? You don't have to do that, but this is where you might consider setting up, for example, specific bequests. So that way, James and Beth, the two kids, can still sit down and have Thanksgiving dinner together and not feel that animosity that when the estate was split 50-50, one ultimately got more than the other. So with cash flow, again, I think it's important to know that your conversation can go a little bit deeper. At this point now, what I'd like to do is go ahead and actually run a poll. I want to know who you think won. So everyone, this is your opportunity. Now that Tom and myself have debated cash flow and goal-based, who do you think has won? And Tom, as these results are coming in, I'm going to kind of take a moment to look at where we're at on the board. Well, Tom, it looks like I've got my king left. How about you?
Looks like we're just down to kings here.
All right. Well, that's interesting. I'm going to go ahead, end the poll now, just so we have time for any questions. But the results are actually kind of what I expected here. So let's share these results and see who won. So hopefully everybody is able to see who has won those results. And surprisingly, it looks like between you and I, Tom, pretty neck and neck, but a lot of folks are realizing that both philosophies are needed. And
Yeah,
I have to tell you, that's kind of surprising to me. How about you?
Yeah, I was going to say it looks like a stalemate here. I mean, for many of you, it's going to be client dependent on the approach you take, I guess. Most chess games shouldn't be ending in a draw, but we've kind of come together with the message that maybe the right planning philosophy depends on the individual. Depends on the approach that you need for that client or that prospect.
Yeah, absolutely. And I don't know about you, Tom, but we could take our kings and go around the board for another hour, but we don't have enough time to do that. And I have to admit, if I think of some takeaways here, I learned a lot from you. With the calculated approach, it definitely probably takes me a lot longer to collect the data that I need. And so I really think that there's some key takeaways for me as it relates to where goal-based might fit if we recognize that there's not one end all be all solution for all clients. So I think those clients that have a good idea of their financial goals or want to get right to the point and just say, hey, tell me how much more to save. Don't try to find the savings. Or they're just really wanting to focus on that big picture. Am I okay or not? I don't need to look at all the detail. I also have to admit, I would lose to a game of speed chess. It definitely seems a little bit more interactive with your approach, putting their life before their money. And, when I think of where this fits, maybe your moderate to high net worth clients, recognizing that cash flow is going to be needed for clients that have, $40 million and they're not looking to spend a lot of money. Really, it comes down to clear and plain data. How about you, Tom?
Yeah, Jerry, there's a lot to be said here. I was going to say, goal-based planning, the first item here, needs advanced estate planning and trust modeling. Goal-based planning it's easier to create and maintain, but it often doesn't provide the foundation needed for that advanced estate planning, especially the creation of those irrevocable trusts that you mentioned, things like GRATs or a SLAT or something of that nature. And without a doubt, pre-retirement cash flow questions, goal-based planning doesn't simply, doesn't surface how the client spends their employment income day to day. Detail that some clients are going to really want to see. This may be the case for them. It's crucial also, I was going to say, I think you mentioned the complexities facing business owners. Those clients do have complex needs, as you mentioned before. How does the income from their business impact their overall financial plan? What if they want to sell the business? How does that impact their cash flow? Maybe they want to put the business in a trust. So things like that. And those needs are probably going to be best accommodated by cash flow planning. Granular tax considerations, without a doubt, cash flow is going to help you better understand tax considerations and consequences prior to retirement. Although goal-based becomes cash flow after retirement, it's obviously going to be more essential for those considerations, and it's also for those business owners. Ultra high net worth, although many of us may not have a great number of those clients, 10 to 30 million assets plus, it's great if you got them, and there's no doubt their needs are going to be unique. I mean, goal-based planning can do some of the heavy lifting needed, but those people are going to have unique tax and estate issues probably best served by the details. That really is going to be mostly cash flow. And then finally, granularity here. So if you could sum it all up in the benefits into one, cash flow provides the details. Granted, it may be more effort to maintain and update, but if the client wants or needs the most details in regards to their day-to-day spending, taxation, and estate planning, cash flow, without a doubt, is going to be their answer. So, yeah.
Yeah, absolutely, Tom. It's been a real pleasure. Hopefully the audience enjoyed our little back and forth. Really, at this point, if you want to learn a little bit more about MoneyGuide and our both goal-based and cash flow-based solution, I'd encourage you to reach out to Brad Barker. He works exclusively with XY Planning Network. Would be happy to set you up with a free trial if you've never seen either one of those systems, help address any pricing questions you have, because there could be preferred pricing depending on if you're a member or non-member of XY Planning. And I don't want to forget our gracious host, Sarah, and the XY Planning Network. They have contact information for both members and non-members as needed, as arose from this discussion. So I do want to take a moment to address some of the questions that have come in. So the first question was discussing the types of planning that could be beneficial even for the same client. I would say, and Tom, you could jump in if you need to, but with cash flow, you may want to start with a goal-based plan. We find that folks really find the data gathering process to be a little bit more comfortable than going through line by line, asking clients very sophisticated questions. Because unfortunately, people don't just wake up wanting a financial plan, but those questions like expectations and concerns can help them realize why they need one. Somebody asked if there's a specific section in MoneyGuide support that does address Wealth Studios. So in the upper right of MoneyGuide, you'll see a support button. And then in the live training section, there are 3 webinars dedicated to Wealth Studios. And then for additional resources on Wealth Studios, which is the cash flow based system in MoneyGuide, there's a variety of user guides, frequently asked questions, videos, and simple reports. So hopefully that helps with that question. Are both options available via MoneyGuide? Yes, they are both available. Feel free to reach out to Brad for more information on that. And then somebody asked an interesting question, starting with a goal-based plan, what percentage of the time do you have to switch towards cash flow? Do you want to address that one, Tom, or you want me to?
Yeah, I would say that, I would mention that in most cases, if you're with most cases, we'll see that you're probably going to be able to use the goal-based planning system. I would say 80 to 90% of the time. That, once you find a client who graduates in a sense to the cash flow system, you're going to have that client who has that high net worth or again needs that granularity prior to retirement. You then move them into the wealth studio or the cash flow based system. Once you've taken them there, they kind of live there because they're going to need that. But we tend to find that many folks then can do just fine depending upon the nature of your clients, but most folks who do just fine with the goal-based planning. It's simpler, it's easier, and it's usually a little easier for them to understand.
Yeah, Tom, kind of on that note, I was thinking, how long do you think it would take you to create a basic plan for a prospect using goal-based?
Real simple. I mean, when you're using goal-based, you can actually create a plan within 5 to 10 minutes and then build it out if you need to. And so it, again, can start real simple. Now, that said, you could take some time with it if you want to with a little more detail. But without a doubt, you're going to need more time with the cash flow. As you've kind of pointed out, Jerry, you just have to be more particular when putting the data in with a cash flow plan because it starts on day one, taking all of that information going forward.
Yeah, I would say for cash flow, it's definitely important that you have accurate data. Remember, any income that's not being spent could be getting saved. You could overstate what somebody is saving. So you really got to be careful. You got to really pay attention to the data entry. As somebody that works with cash flow a lot, one of the most common struggles folks do have is they try to get through the data entry too quickly and end up with results that don't often make sense. And that's why, because we are accounting for every dollar, you do need to kind of be specific there. Your client's liabilities will absolutely impact their plan's result. Whereas you may be working with somebody that doesn't know the outstanding balance, interest rate, or monthly payment on, for example, their mortgage or credit card or car loan. So definitely a interesting takeaway as we kind of consider when somebody might need to graduate to a cash flow plan. But if you start with a goal plan, the beauty is with using MoneyGuide tools, all the data you put into the goal plan really helps to fill out the data entry of the cash flow
Absolutely.
plan.
Yeah, and to my point earlier, although I don't think most clients will need the cash flow, those who do often really need it. That is something that they absolutely have to have.
Absolutely. Well, it looks like Tom and I have addressed all the questions that I have seen come in that weren't addressed via live chat. So, Sarah, would you like to come in for some closing thoughts?
Absolutely. Just to start, you guys did fantastic. I learned so much from you, and it was just such a pleasure to see you both just bouncing off of each other and sharing that the fact of the matter is there is no right way or wrong way as far as these different types of planning. So thank you so much for your time. Really, really appreciate it. It was fantastic. And to all of you who stayed with us, thank you so much for giving us your time and spending this hour with us. We so appreciate it. If you are interested in scheduling a call with an XYPN success strategist just to learn more about XYPN, then I'm going to drop a link and you can please find a time that just works for you just via that link chat. And then if you're interested in learning more about MoneyGuide, then as Jerry and Tom have alluded to, you can contact Brad Barker, the MoneyGuide account manager who works exclusively with XYPN members. So I will share the phone number that he also has, as well as his email address. And this information will be accessible in the follow-up email that we'll send as well. And as a reminder, XYPN members receive a 30% discount or more on many of the MoneyGuide solutions. And unique to XYPN members, you get access to month-to-month payment terms instead of annual. So that is really great. And then lastly, you will receive a feedback survey pop-up after this webinar. So please, if you can, just take a moment to give us a rating and suggest any topics of interest. We love feedback and we would love to know what you thought about this. So thank you all. Thank you again, Tom, Jerry. It was so fantastic.
Thank you.
And I hope that you all have a good rest of your day.
Yes, thank you,
You
Sarah.
too.
Thank you for your team and helping us bring this webinar to life. Tom, you're a fierce competitor. And for everyone, I hope you have
I
a
got you,
great
Jer.
rest of your week.
Take care, folks.
Bye-bye.